want to build wealth without constantly, worrying about every market fluctuation, thinking about starting small, consistent amounts and letting compounding, well, do the heavy lifting for you. Today, we're taking a deep dive into SIP. That's the Systematic Investment Plan. It's a really simple, pretty smart way to approach investing, specifically in mutual funds. Our mission for this deep dive is clear. By the end, you'll have a really solid grasp of exactly how SIP works, how it can, significantly grow your money over time, and the practical step to get you started, like today. Okay, let's unpack this. So let's kick things off. What exactly is an SIP? It stands for Systematic Investment Plan. Okay, but what does that mean? At its core, it's basically a method. You commit to investing a fixed amount of money. At regular intervals, usually monthly, that's the most common, into a mutual fund. Yeah, think of it less like a one-off deposit and more like a regular commitment, like a subscription. But instead of spending, you're actually investing consistently. You decide the amount, you pick the fund, choose the date, and then the whole thing becomes automatic. It takes the active decision-making out of saving regularly.
And it's precisely that automation, that consistency that's so powerful. For a lot of people, the idea of actively managing investments, well, it can feel overwhelming.
Right.
It leads to hesitation, maybe inconsistent saving. SIPs, they sort of take the guesswork and, frankly, the emotional stress out of trying to time the market or even just deciding when to invest each month. It builds that financial discipline right into your routine, which honestly is half the battle won for long-term wealth creation.
Right, the consistency. And that's where the magic really starts to happen, especially when we look at the three main advantages SIPs offer. First up, and this is a big one, is rupee cost averaging. Sounds technical, but the concept is simple. It's like your built-in market shock absorber. When markets dip, your fixed SIP amount automatically buys more units of the fund because the price is lower. Conversely, when markets rise, that same fixed amount buys fewer units because they're more expensive. You're buying across different price points.
That's such a critical point. It tackles one of the biggest fears investors have, putting all their money in right at a market peak, Rupee cost averaging smooths out that ride. Instead of trying to guess the absolute perfect time to invest, which, let's be honest, is nearly impossible, even for professionals, you're just averaging your purchase cost over the whole time you're investing. It takes the stress of market timing right off the table. You benefit whether the market's up or down in any given month because you're consistently buying.
Exactly. And the very way SIPs work brings us straight to the second advantage, discipline and convenience. Because you set it up to auto-debit, typically from your bank account, it just happens. It forces you, in a good way, to save regularly. It builds that consistent saving habit without you having to consciously decide or remember every single month. It's, well, the ultimate set it and mostly forget it tool for regular saving.
It really is. I've seen so many people who intend to invest regularly. They have the best intentions, but life happens, right? Bills pop up, unexpected costs, or maybe just, forgetting. And those good intentions, they often fall by the wayside. The sheer convenience of that auto debit ensures your long-term financial goals aren't derailed by procrastination or just the busyness of daily life. It's consistency on autopilot. That's incredibly valuable.
And then the third advantage, this is one often called the eighth wonder of the world, the magic of compounding. Simply put, it's your earnings earning their own returns. It's when the profit you make starts generating its own profit. This snowball effect is, well, it's extraordinary. And the earlier you start, even with tiny amounts, the more time compounding has to work its magic. Time is your biggest ally here, truly.
What's often missed about compounding is how deceptively slow it feels at the start. You might invest for a year, maybe two, and think, is this really doing much? But then as time marches on, that growth curve starts to steepen. It really accelerates. It's like that classic snowball rolling down a hill analogy. Starts small, picks up speed and size, growing faster and faster. That initial patience, sticking with that consistent, systematic investment, that's what unlocks those really quite astonishing results over, say, decades.
Okay, so the basic idea of an SIP is simple, which is great. But there are actually a few variations out there designed for different needs. The most common one is the regular SIP, which is what we've been talking about. A fixed amount invested regularly, usually monthly, straightforward. But then you have something called a top-up SIP. This is pretty neat. It lets you increase your SIP amount periodically. So, for example, maybe once a year, you automatically increase your monthly investment by, say, 10%. You can align it with salary hikes or just generally boost your savings rate over time. It helps fight inflation and speeds things up.
And that flexibility is really key because life isn't always linear, right? which leads to another type, the flexible SIP. This one offers even more adaptability. It lets you actually change the investment amount based on your current cash flow. Maybe you have a bonus one month, you could invest a bit more. Or if things are tight, you could potentially scale back temporarily without stopping completely. That adaptability helps maintain the discipline through, life's ups and downs.
Exactly. And for those who like a bit more strategy, some platforms offer trigger a SIP. This is a bit more advanced. Your SIP investment happens not just on a fixed date, but when a specific market triggers hit, maybe the index falls by a certain percentage or a stock reaches a certain price. It needs more monitoring, but it's an option. All right, theory is great, but seeing is believing. Let's put some real numbers to this. Let's see how it actually grows. Imagine you decide, okay, I'm going to invest 5,000 euro every single month for 10 years. And let's assume a reasonable, historically achievable average annual return of 12%. Now, there's a formula for this, the future value of an SIP. We don't need to get bogged down in the math itself. Just understand it takes your regular payment, the rate of return, and the time period, and it calculates the future pot of money. So the inputs here are P, the monthly amount is 5,000. The annual rate is 12%, so the monthly rate R is 1% or zero point 0.01. Simple enough. And the time N is 10 years times 12 months, so 120 months in total. Okay, so we plug these numbers into the formula, let the calculator do this work. And that consistent 5,000 euros a month over those 10 years, assuming that 12% annual return, it grows to 150,193.45. So yeah, roughly 11.5 lakh.
That number often catches people by surprise. It's a significant sum. But what's even more revealing is when you compare it to what you actually put in.
Absolutely. Let's do that. Your total invested amount, that's 5,000 multiplied by 120 months, which equals 600,000. 6 lakh rupees. That's what came out of your pocket over the decade. So the growth on your investment is approximately 5,050,193. That's over 500,000 rupees in pure profit. Just from the power of compounding and that consistent, disciplined 5,000 euro round investment each month, it really shows how patience and regular effort can build substantial wealth.
It really does highlight how those seemingly small, regular contributions can pile up into something quite significant over time. It changes how you think about small efforts, doesn't it? They're definitely not small when you give them time and consistency. It really proves that principle. Consistency often beats trying to make big, infrequent splashes.
Okay, so we see the potential. Now, where do SIPs best fit into your overall financial plan? What kind of goals are they good for? Generally, SIPs are ideal for goals that are, several years away. We're talking medium to long-term objectives here. Think about things like building a retirement fund over many years, or saving for your child's higher education down the road, or maybe building up a down payment for a house, but you won't need it for 5, 7, 10 years. Perfect scenarios for an SIP.
But, and this is important, you need to match the tool to the time frame. For very short-term goals, let's say anything less than maybe 2 years, SIPs usually aren't the best approach. Why? Well, while SIPs average out volatility over the long run, in the short term, market swings can still significantly affect your principal amount. You could end up needing the money when the market is down. For those really near-term needs, you're generally better off with safer, less volatile options. Things like liquid funds, maybe ultra-short-term debt funds, or even just a high-yield savings account. Safety first for short horizons.
That's a really crucial distinction. Okay, so let's say you've figured out your goal, your time frame, and SIP seems like the right fit. How do you actually choose a specific SIP and the mutual fund to go with it? Well, it needs a structured approach. The absolute first step, not negotiable really, is to be crystal clear on your investment goals and your time frame. Everything flows from that.
Exactly. And that clarity directly points you towards the type of fund. So for instance, if your goal is more than 5 years away, equity funds generally make sense. They have higher growth potential, even though they also come with more ups and downs, more volatility. For a medium term, say 3 to 5 years, maybe hybrid funds are suitable. They mix equity and debt, trying to offer a balance between growth and stability. And like we just said, for very short-term goals, debt or liquid funds are usually the way to go for capital preservation.
Okay, so you've narrowed down the fund type. Now you're looking at specific funds. What should you check? Always look at the fund's track record, its history. But big caution here, don't just chase last year's winner. Past performance doesn't guarantee future results. Look for consistency over multiple market cycles, maybe 3, 5, 7 years. Also look very closely at the expense ratio. That's the annual fee the fund charges. Lower is generally better, as it means more of your money is working for you, not going towards fees. And yeah, it's worth looking into the fund manager's experience and their investment style or philosophy. Is it consistent? Does it align with the fund's objective? Your own personal risk appetite is huge here too. How much volatility can you comfortably handle? This might guide you towards certain categories, like large-cap funds invest in big, established companies, usually seen as more stable. Flexi-cap funds give the manager freedom to invest across company sizes, potentially capturing more growth, but maybe with more risk. And balanced funds, or hybrid funds, as we mentioned, offer that built-in mix of stocks and bonds, good for moderate risk tolerance.
Fund selection ultimately isn't about finding the single best fund in the universe. It's about finding the fund that's the best fit for your goals, your time frame, and importantly, your comfort level with risk. It's a truly personalized decision. What works for your friend might be totally wrong for you. It shifts the focus from just performance numbers to suitability.
Good point. And like any investment, you absolutely need to be aware of taxes and charges. These can impact your actual take-home returns. For equity mutual funds, if you hold them for more than 12 months, you typically face long-term capital gains (LTCG) tax. Gains over 1 lakh in a financial year are taxed at 10%. If you sell within 12 months, it's considered short-term capital gains (STCG), and those gains are taxed at 15%, assuming securities transaction tax or STT was paid.
Right, and STT is that small tax applied when you buy or sell securities on Indian stock exchanges. It usually applies on the selling side for equity funds. Also, beyond taxes, something else to watch for is exit loads. Some funds charge this fee if you redeem or sell your units before a certain period is over, maybe 1 year, sometimes 2. It's basically to discourage very short-term trading. Always check the fund documents for these details. Understanding taxes and exit loads is crucial for figuring out your actual net returns.
Okay, let's shift gears slightly. Let's talk practical tips. Some SIP hacks and best practices to really make this work well for you. First, and honestly, I can't stress this enough, start early. Even if it's just a small amount, like $500 or $1,000 a month. Starting early gives compounding more time to work its magic. That time in the market is often way more important than trying to time the market or starting with a huge amount later. Second, try to increase your SIP amount yearly. Use that top-up SIP feature if it's available, or just manually increase it. As your income grows, bumping up your SIP helps counteract inflation and seriously accelerates your wealth building. Even a 5–10% increase each year makes a huge difference over time. Third, automate everything. Set up that auto debit, the ECS mandate from your bank. Make it seamless. This ensures you never miss an SIP date and keeps that crucial consistency going without relying on willpower.
And here's one that sounds simple but can be emotionally tough. Don't panic during market dips. It's natural to feel nervous when markets fall. But stopping your SIPs then is often the worst move. Remember rupee cost averaging. Those downturns are when your fixed SIP amount buys more units at lower prices. Sticking with it means you benefit more when the market eventually recovers. Resist that urge to pause or stop when things look grim.
Exactly. And related to that, review, but don't constantly switch. It's good practice to review your SIPs and funds maybe once a year. Check if they're still aligned with your goals. But avoid the temptation to jump between funds based on short-term news or performance blips. Give your chosen funds time to perform. Frequent churning often hurts returns due to costs and missed opportunities. And crucially, this maybe should have been first. Have an emergency fund first. Before you start investing heavily in SIPs, make sure you have a separate stash of cash, maybe 3–6 months of expenses in a safe place like a savings account. This buffer protects your long-term investments. It means you won't be forced to stop your SIPs or sell investments at a bad time if an unexpected expense crops up.
You know, when you look at these best practices, many of them boil down less to complex financial strategy and more to behavioral finance. It's about cultivating patience, maintaining discipline, trusting the process over the long haul rather than reacting emotionally to every market swing. That psychological strength, that discipline, often has a bigger impact than picking the absolute perfect fund.
Yeah, absolutely. And speaking of reactions, let's quickly cover some common mistakes. Pitfalls you really want to steer clear of with SIPs. First, that short-term chasing we mentioned. Seriously, don't pick funds just because they had a great last year. Look at the 3-year, 5-year, even 10-year picture for consistency. Short-term returns can be very misleading. Second, avoid fear-driven churning. Constantly switching funds because of market jitters or 1 quarter of bad performance. Usually a bad idea. Trust your initial research. Understand markets go up and down. Stick to your plan unless something fundamentally changes about the fund or your goals. Third, ignoring fees. Don't overlook the expense ratio and any potential exit loads. These directly reduce your returns over time. A small difference in fees can add up significantly over decades. Pay attention to costs.
And perhaps the most damaging mistake, linked to the don't panic point, is stopping your SIP when the market is down, locking in losses. This completely defeats the purpose of rupee cost averaging. You stop buying when prices are low, and you crystallize your paper losses into real ones. It prevents your investment from recovering when the market inevitably turns. It's tough psychologically, but sticking with the plan through downturns is precisely how long-term wealth is often built in equity markets. Avoiding these common behavioral traps is often more important than finding the absolute top-performing fund each year.
So there we have it. We've taken a pretty deep dive into systematic investment plans. We've seen how this simple, disciplined approach, really powered by rupee cost averaging and that incredible magic of compounding, can be a truly straightforward and accessible path to building significant wealth over the long term.
What's fascinating here isn't just the financial mechanics, so they are powerful. It's the profound psychological shift that SIPs encourage. It's really about cultivating patience, building discipline, and adopting a long-term perspective in a world that, let's face it, often pushes for instant gratification. So this raises an important question for you, the listener. How might embracing the systematic long-term approach in your finances? How might that empower you to apply similar principles, consistent effort, delayed gratification to other important areas of your life beyond just your investments?
That's a really powerful thought to leave everyone with, something to definitely mull over. We really encourage you to reflect on your own financial goals and consider how a structured, consistent approach like SIP could be a powerful tool in your own wealth-building journey. It's accessible to almost everyone. Thank you so much for joining us in this deep dive today. Here's to making informed choices, staying disciplined, and letting your money work smarter for you.